Yeah, is the screen visible?
Yep, it's visible.
Okay. Right. Uh, okay, let's just basically start off with the different kinds of spreads that you have, right? The first kind of spread that you have in options is called the credit spread. Okay, so I don't really want you guys to memorize what the charts are and what the, what exact strike you should buy or what the max loss is, the value, net premium, or maybe it's spread minus net premium. I want you guys to understand the basics. And once you guys understand the initial four strategies that we do, whatever strategy you hear of in the future will just be a combination of the same. Hope that's very important. Just understand what's going on, and that's it. Just understand the first four. Okay, so credit spreads, as the name suggests, this is a strategy you will be executing and you will be getting some money out of it. Basically, you will be short here. You will be short net options. So that's basically what a credit spread means. And when you're short options, I mean, we've discussed the Greeks already. So I hope this is extremely clear to all of you that if you are selling options, you want to sell the options when IV is pretty high so that when the IV falls down, your premiums decay in value even more and you make money. Okay? The other thing is that theta is always with you. So whenever you're selling an option, whenever you have credit spread in place, theta will be helping you out. So you want to be so the closer you get to expiry, the more money you make. Okay. Now the most common strategy which beginners should implement. Now I prefer credit spreads over debit spreads mainly because I prefer being short. At least I have some edge. I have certain advantage. At least I have theta with me. I can't really control the other Greeks or the direction of the markets, but at least theta is there. Okay. So the two most commonly used strats that I use are bear call spreads and bull put spreads. Okay. So bear call. This is a strat you implement. Like somebody, Divine Rapia asked this question today. So this is the spread that you use when the markets have rallied. So the call premiums have swelled up. So let's just say you have looked at Nifty's chart right now. You've seen that it's gone up from 16,800 all the way to its current price of 17,200, but it's been unable to break it. And if you draw support and resistance and demand and supply zones, you will also see that we are pretty close to a zone over there as well. Plus, you guys can see my screen. I mean, I think we have OI data here as well. Uh, if I check Bank Nifty, one second. Even over here, it should be fairly easy to spot exactly what's happening in the markets. Yeah, so this is Bank Nifty. And again, what you'll see is that the markets have gone up slowly going long. They aren't really present in the markets in the same numbers. Okay, so in such a situation where you've looked at the OI and you will be learning how to analyze OI properly and stuff like that. But I'm just saying this is just one example. It could be OI, it could be based on your candlestick patterns, it could be based on whatever technical analysis or price action you use. But once you form the view, okay, the markets have gone up, the call values are really high right now. Why don't I short the markets? And if this is your view, the best thing you should implement is a bear call spread. So this is the ideal time to implement a bear call spread. Okay. Now, what does a bear call spread? I have to go back to strategy builder. You're basically buying a call. You're basically buying out the money call and selling in the money calls. Right? Out the money calls. Okay, no, I don't want Bank Nifty. I want Nifty. And I hope we've understood moneyness of an option, right? So this is the current strike, 17200. This is where Nifty is currently at. So what I'm basically saying is buy a strike which is out the money. So 13,300 or 400 is out the money. So just buy this, and you can sell something. Okay, let's just go for 300 for simplicity's sake. And you can sell something which is in the money. You can sell this strike 150. Okay. Yeah, and this is basically what it looks like. I hope it's all clear to you guys. Now the current price of the stock is at 17213, and since you're short overall, you make money since the best strategy using calls. You will make money when the markets fall down. Now the problem here is that some people do get scared when they look at this what the max profit is compared to the max loss. So your max loss in this instance, especially it is usually higher. It depends on the strike prices, of course. And that is not really something you should be scared about because it's just the loss you will make on the final day. Now over here, since this is the final day, you're just seeing one line. But let me just change this expiry date and then you should be able to see a difference. Let me change this to 6 Jan. Yeah, you can see this blue line, right? Now this blue line is where your profit and loss will actually be at. So even if you exit, if you exit before the last day, you will make a limited loss. So even if it goes all the way down to 17500 tomorrow, even if it goes up all the way there, you will still lose 2K. So your stop loss can be there. Your stop loss can be 2K. Max can be 3. Don't get by looking at just the profit loss numbers and what the risk to reward ratio is. That's an incomplete view, in my opinion. Now, one thing to note is your current break even. Okay, this is somewhat of an advantage that you have here, at least a break even. You have a bit of a buffer, at least 15 points of a buffer, which is again represented in the probability of profit. Okay. And I really enjoy these kinds of trades since you have theta with you. All you really need is for the markets to fall down. Now let's just look at the 6 Jan example. Okay, because tomorrow's expiry is way too close. So looking at this current example, how do you actually trade this? You let me assume I take this trade tomorrow, 6 Jan. I am pretty bearish, so I just sell these options. And now when I sell these options, if it falls significantly within the first couple of days or within 2-3 days, there is a high probability that I will make, say, let's just say $2,500 or something of that sort. Okay. And that could just be a good enough return for me. So I can close that position and then open another one. I don't have to wait the entire while. Just because I've taken a weekly position, it doesn't mean you have to hold it until you exit. Even though for most beginners, this is something which you should do since your entire and understanding and figuring out technical analysis and price action and whatever your personal views are. But still, this is extremely important, and this is something you can try. Like if there's a big ass move in one direction, in your direction, let's just assume there is a probability, of course, I don't know what the numbers are, but there is a probability that Nifty falls all the way down to 16,800 again. And this could happen within the next couple of days. This could happen on Monday. So if it does happen on Monday and Nifty falls all the way down to 16,800, okay, you've already made 3K and your stop loss was somewhere around 2K, if you remember correctly. So you have two options now. You can either hold on to this trade, and since it has moved so much and there is just 4 days left now, since theta is with you, you can either hold on to this trade and take out all of the money possible, let it run all the way to 3,900, which is the max profit, or you can do something else. You can just close off this position at $3,000 and start a new one. Again, since this time, let's just assume the markets have fallen all the way to 16,800, and now since there's been a crazy down move in such a big time, you could, now that the put prices have swelled up, now that the markets are extremely bearish, this is when you can utilize selling puts and then going long. Okay, this is where a bull put spread comes into play. So I hope you understand when to use a bear call spread and when to use a bull put spread. So when you're inverting everything, it just makes sense. Okay, so when the markets have significantly fallen or significantly gone up in value, this is when you implement all these strategies. Now let's just look at the strike prices and play around with them to understand how all of this actually plays out in real life. Okay, now what if I change the strike prices? Let me clear all trades. And now initially we were buying out the money, right? We were buying something in this range, and then we were selling something here. Okay, what if we buy this? What if we buy at the money? And what if we sell in the money? Okay, 150 point ka hi rakhte, so it will remain uniform. So what happens in this particular instance? In this instance, your max profit is extremely high. Your max loss is extremely low. The break even, however, and the probability of profit of your trade, they really fall down drastically. Yeah, so this is one difference. So when you go in the money, this is the difference, right? And hopefully from now itself, you can have a general idea of what will happen if we now select both out the money strikes. Okay? And obviously, how do you come up with all of these numbers? How do you come up with the break even and everything? Now, first of all, there's something called your max profit. Your max profit is nothing. Since you have sold options, you basically want both of them to go to zero. You want this to go to zero and this to go to zero, right? So if you want Nifty to, let's assume, go down all the way to 16,800. And if Nifty goes all the way down to here, what's the value of this call? Zero. So you lose 50 bucks here. And since you've sold this option, you will make 160 bucks. So what is your max profit, your net profit? Your net profit is basically 160 minus 52. Okay. I just want to check. You guys can hear me properly?
Yep. All clear.
Yeah, there's no disturbance this time, right?
No.
Okay, okay. 1 second. Yeah, so fairly simple so far. Your max loss when you're implementing a credit spread is this, right? 160 minus 52. 160 minus 52 is around 110. Multiply that by your lot size. Your lot size in the case of Nifty is 50. So 110 into 50 should be 5,500, which is exactly what you can see here. I mean, not exactly, but you get the idea. And what's your max loss? Your max loss is basically the difference between these strikes, and you subtract that by the difference between the numbers here. So this minus this. So the difference is 150, 150 minus whatever the number here is. Okay, so you get 40 bucks, 40 into 50, right? 150 minus 110, you get 40, 40 into 50, 2K. This is the number that you can see right here. For beginners, I don't really recommend going for trades like this where your probability of profit is, pretty bad, even though the risk to reward ratio is 2.6. It looks amazing. Your returns are really good. The margin is the same. However, the probability that you will actually make money here is really, really low, right? And you need the markets to significantly fall to have any chance. Because if this just keeps going in the same direction, you will just lose money. Okay. Now, let's just look at out the monies, which is what I recommend for most people. And uh, let's change this to out the monies. Yeah. So we'll buy 10, 17, 300 in this instance. I mean, we'll sell, and then we can buy maybe 450. Okay, keeping the same 150 point difference. Okay. Now this is the type of trade I really like. I don't really care about what the max profit and max loss says. What I'm basically looking for is a probability of profit. Now Nifty is currently at 17213, and look at my break even. My break even is roughly 150 points ahead. Okay, 140, 120, whatever the number exactly is. But at least I have a buffer. Until that point, I can still make adjustments. So even if the markets fall all the way down to here, for a lot, I'm just losing 500 bucks. So even if the market goes up by an entire, let's just say, an entire 200 points. So 413. Even in this case, I'm losing 1.5K. Okay, this is the max amount of money that I can lose before changing. So I have significant time for my mind to react to issues. So you have this time where you can think, okay, maybe my view is wrong. Should I just close this position because I don't understand these markets? And this is very common. Nobody knows what the markets will do all the time. You basically have periods where you make money. You have these phases where you can properly understand exactly what the market is doing. It seems like everything is going in your favor, and that's when you should trade. If you have a feeling, okay, I took this trade based on the fact that they expect the markets to fall, they aren't, they're going upwards. Okay, let me just book my loss right here. At least you have a buffer before you actually lose a significant amount of money, which is not really the case in the other one. So let me just go back to the previous example that we taken. I don't remember the strikes now. I think 300 and 150. Okay, it doesn't really matter. Now in this case, right, suppose the markets go all the way here, and they, again, I'm completely wrong again, and the markets are at 17400. Now for me, for this trade to actually make me money, look at the distance between the current price 17400 and 17155. It's a huge gap which will probably not be covered. This is a 250 point move that you expect in your direction. Whereas when you sell out of the monies, you're much, much safer. Yeah, so in this instance, even the markets fall by a proper 200 points, okay, and it's now reached 17400 or whatever, you still have your break even right there. So despite the markets moving by a huge chunk, despite the markets moving by 200, to break even, all you really need is just 20, 30, 50 points, which is nothing, which can just happen within, an hour, which an hour is even, a long enough period of time. This can happen in a couple of candles. So despite being wrong, despite being so damn wrong, you will still have the opportunity to either exit at a small loss, or you can even hold on to your trade if you are extremely certain, and still have the probability of breaking even at least. In the previous case, when you look at in the monies, there was literally no scope of that happening. So I hope this is clear. Any doubt so far? We're just covering one thing, bear call spreads. That's it. Questions?
Like, no doubts from my side. You can continue.
Sorry. Okay. Second, again, bull puts. This is the exact same scenario. You can just inverse all of this. This is when you use in the markets have really declined. So puts have more value right now. The ratios between what the value of a put is and the value of a call is different. And again, since you have sold the credit spread, everything remains the same. What are you basically buying? You will do the exact same thing. You're buying something, which is you're buying something out of the money, and you're selling something which is slightly in the money, right? That's all it is. There's a difference between the strikes where you're buying something which is even further out. That's all. Even if you're selling out the money, you are buying something which is even further out the money. That's all it is. And everything else remains the same. So your max profit, max loss, what your break evens are, they all remain the exact same. Okay. See, we can just see that play out. Yeah, just buy something out the money here. Okay, so this is basically it, and everything remains the same. So what's the difference here? 30th December. 80 minus 20, okay, 50, 60 bucks cash pass. And whatever the number you find here is 60 into your lot size, that's giving you whatever your profit is. Okay, and your max loss is again the difference here, 150 minus whatever here is. So 150 minus 50, which is roughly equal to 100. 150 minus 60, which is roughly equal to whatever 90, 100 k आसपास, multiply by 50, which is around 5k, and that's the exact number that you see here. So your math, everything remains the same. There's no difference as such between understanding or anything else. Again, what I would recommend in this case is just go for out the monies, and it's not like just because your probability of profit, it means your returns will be extremely low. Not really. You can always hold on to positions. You can close them off early if possible, if you're extremely sure that the markets will continue in this direction. I understand the way the markets are moving. And then you can take on new positions, whereas you do have a stop loss in place. Now, where exactly should your stop loss be? That depends on how you work things out. What some people look at is something extremely simple, like just looking at delta. Let me delta, yeah. Okay, so the point I was trying to make is what some people do is, especially if they've sold something which is out the money, as we know, ATMs usually have a delta of 0.5, right? In the money options and extreme in the money option will have a delta of 1 because it's basically moving like a future, right? Now the monies, it will be closer to 0. So let's just assume I have a position in which my delta is 0.2. And now you can just have a very non-discretionary system where if your delta touches 0.5, you can just straight up exit your position and that's it. There's no need to think, there's no need to be like, okay, what if the market falls or goes up from here in my direction? It doesn't really matter. All you can just do is have fixed guidelines in place, 0.2 beta, 0.5 beta, that's when I'll close this position, that's my max stop loss. Okay, so don't really be worried about what all of this, what exactly the max profit and max loss is, as long as you can monitor the markets and figure out whatever your system is. Okay, so everything else here remains the same. I hope this is fine as well. We just have two more strats to cover, and we're basically done. I mean, everything else you will ever hear will just be a modification of the same thing. Okay. Now, slightly different, bull calls. Now, bull calls are a part of debit spreads. Debit spreads, again, just understand this generally. When you're going for debit spreads, you are paying a certain premium. Whether you have 5 legs or 10 legs, it doesn't really matter. You are paying a certain amount of premium. So you're buying an option, net average. You have 10 legs, it doesn't really matter as long as 6 are bought and they have more value. Okay. So in this case, what will happen again? IV, when exactly do you want the IV to be? You want the IV to be low because when the IV goes up, your options will make you more money. And where exactly, how does theta affect your entire strat? Theta will be negative for you because theta will keep taking away value from your profits. This is what you have to understand. Like just understand from a very macro level, and that's it. You don't really need to mug up anything of this sort. Okay, bull call, you want the theta, you know theta will be negative for you, and you want the IV to be low because if the IV goes up, your options will gain more value. Here, it's very simple. You can just buy a more valuable call in a bull call spread and sell something out of money. Just buy something more valuable. So usually, yeah, you can just buy this call and sell something out the money. So yeah, in this case, this is fairly straightforward as well. This is the basic opposite or mirror image of what happened previously when we were using calls to short the market. Here, you're using calls and you're going long. Here, obviously, your max profit is much better. Your max loss is limited. Your risk to reward ratio is at 2.3, which is amazing. But your probability of profit is the issue. Your probability of profit is 43%. You need the markets to go up by at least 30, 40 points for this to break even, not make money, just break even. So this is where it all comes into play. In the other strat, when we are selling options, we have a 30, 40 point buffer. Even if the market goes against us, we can still make something out of it. But in this case, there's absolutely nothing you can do. Just look at 6 Jan. Yeah, this is a better representation of what should happen. But the numbers are slightly skewed with tomorrow being expiry, right? So in tomorrow's expiry, 17350 will have extremely low value. Yeah, so your hedges won't really be the same way. Okay, here your max profit again. Just inverse everything that you did previously. In the last strat in credit spreads when we looked at pull calls, sorry, when we look at the previous strategies, what was your max profit? Your max profit was this going to zero and this going to zero. In this case, this will be a max loss. So your max loss will be 169, 170 minus 100, which is 70 points, so 70 into 50, which gives you whatever, right? 3505. And your max profit here is the spread. Again, we've maintained 150, just so you guys can compare the different strategies that we're talking about. So 150 minus 70. Okay, so that's the difference here. So everything plays out fairly logically. There's nothing to learn or mug up. Okay. Again, even in this case, you can play around with different strikes and then you can come up with a completely different position. So take a look at this. Yeah, so here what you're basically doing is you're buying something which is out of the money, 17500 for 6 Jan, and just selling 17650. So in this case, the probability of profit is low, but your break even becomes extremely wide, right? But if it does reach that level, you will make a lot of money. So this is the advantage. And look at the problems here. This graph, it clearly shows you the blue line is what will happen on your current day. The solid line is on the day of expiry. Okay. So even if the market goes up in your favor, it's at 17200, goes up to 17400. The same number with you in the previous example. You've made 1,000 bucks, but on the next day, even if there's a small deviation or the market doesn't continue moving, on the day of expiry, you will lose money. You actually need the markets to go up a lot more to actually break even. So this is why strategies like this are not really recommended. The only time you can implement something of this sort is when, let's just assume you have like a crazy conviction view, or you want to YOLO some money, or you think the risk to reward ratio is something extreme, maybe like 5:1 or something of that sort. In those exceptional cases. Otherwise, this isn't really recommended. But yeah, people who have backtested the strategies and are extremely fond of going long, bulls, they do prefer bull call spreads as well. What's the difference between buying a regular bull call spread as compared to just buying a regular call? The difference, you do get certain theta advantages, right? So if you had just bought a call, theta's impact on a strategy would be extremely negative because just have one leg. Here, at least you sold something. So that's just that selling of that option will help you out somewhat because the net strat, it will have, obviously theta will be negative for it, but it won't be as negative as compared to if you were naked. So this is the benefit that you get. At least you can counteract the negative effects of the grease. Okay. Yeah, I guess this is all clear. Uh, how to implement this by looking at price action on charts. I explained this, right? That I can just look at OI. I can just look at OI, have like a basic view of the markets will go up or go down, or price action remains the same. Like I can just look at the charts, think that this will fall, and then take a position. If the markets are extremely bullish, like they are currently, this is when I think it will be a perfect time to implement like a bear call spread. Yeah, so implement this by looking at price action in charts. Yeah, just look at what the markets are doing, and then you can make up your strats. This is just probability, right?
So are we going to do this for intraday or for like a positional hold?
It depends on you. Do whatever you want.
Okay, okay.
Depends on you. As long as you understand the basics, you don't really need to even know the words. I mean, it's all good.
Yeah, sure, sure, sure.
Mm. The last basic strat, and we'll just look at bear puts again. The exact same thing. Nothing new to learn here. Buy something in the money, sell something. Yeah, and this is exactly the same. Right? The probability of profit is slightly lower. Your break even, again, you need the markets to move in your direction to even start making money. But then the max profit and max loss, the risk to reward ratio is in your favor. This is the advantage that you get. The problem is the probability of profit, right? And once the market goes upwards, since this is a debit spread, with every passing day, even the markets doesn't move against you, you will just start bleeding money and bleeding money and bleeding money. So in credit spreads, it's much easier. I think somebody flagged. Yeah, okay. What kind of adjustments can you do in a credit spread? You can convert the positions entirely if you want to. You can close your positions, you can add to it, you can average them down, you can close off one leg. There's just so much you can do, man. There is just so much. Yeah, so you can convert the position, you can move one leg entirely, and you might just have had like this does happen in a few cases where I have implemented like a pair call spread. I expect the markets to fall, but then eventually what happens is I think my view is completely wrong and I should have been long. And those cases, I can just remove my hedge, I can just remove my sold call, and now I'm just long a call, and then hedge that differently, or convert that to a different strategy. You can even convert all of this into proper iron condors and stuff. So you can look at all of that later. We'll discuss all of that. We'll discuss all of that. Question by Divine. Today's intraday OI showed a big put OI for 17200, but during the last trading hours, the game completely turned around. What do you mean by the game completely turned around? Big put OI, but then the markets fell. I mean, it's not like you can look at OI and just form a view. These are just tools in your arsenal. They won't tell you exactly what's happening. You can't say that just because you had some buying pressure or selling pressure, everything is now different. These are just ways to help you identify certain trends. That's all. There's nothing which is set in stone. Just because the OI indicates something doesn't mean that will always happen. Yeah. And even now, I mean, even despite the fall, it's still at 17200. It hasn't broken. So there's no big difference just because it fell by 30, 40, 50 points. I mean, that is nothing. That is insignificant. Okay, I think over here there is really nothing to explain. Everything remains the same. What your net debit is whatever you've paid minus whatever you received. Your break even, your max profit, your max losses, again your net debit, your max profit. Again, look at the spread. Take whatever 150, subtract this number, this 50 number from here, and then you're done, right? So 150 minus 60 and multiply that by 50. That's 90. 90 into 5, 4,500 right here. Okay. Again, your probability of profit is slightly lower, so you need to have really good conviction in order to take these trades. For beginners, I wouldn't recommend them. Okay. And now with these four, everything else that you will hear later on will just be modifications of the same. There's nothing really new which is happening. These are just different strats, different names, and yeah, it's fairly simple. So let's just move on. The next thing we'll look at is a call ratio back spread. This is again implemented when you're extremely bullish. You sell something which is in the money. So 300. Okay. So this is basically what a call ratio back spread looks like. Over here, the advantage is go again that at zero or whatever number I'm going to put place here. 30 December 6 January. This is a far more likely scenario where you are extremely bullish. You expect like a major markets away from 2SD. However, if the markets go completely against you and they fall, you don't really lose much. Okay, this is when you would implement a strat like this. Now, in this particular case, obviously looking at the probability of profit, it doesn't make sense at all. This is the strat you would implement if the market falls down to 16800 tomorrow, and then we find like the cure for COVID or something of that sort. This is when you can implement this strat. Why take this over buying a call? Again, at least have some downside protection, right? And the Greeks aren't completely against you, if, because this is a credit strat. Usually, what you're basically looking at, this is important. So, call ratio back spreads are a credit strat where where the Greeks, theta, and everything they work for you. So again, you want the IVs to be high. And if there's a bullish move, maybe volatility cools off completely, and you will make a lot of money. Okay. Your max loss and everything, it just remains the same. Your max loss is a spread. So 150 here minus whatever here is. What's your max profit? Again, this number. Okay. So this is what a call ratio back spread is. All I hope is understood that why this get the Greeks to work for you despite having extremely bullish. This is gold fall down. We will lose a certain amount of money. So let's just get into it.
Something went wrong. We are not able to hear.
We can't hear you.
Okay, wait, let me just. Mm, yeah, all okay? All good? We'll continue.
Okay.
Yep, all good.
Uh, ठीक है ना? So we'll continue. If there is an issue, just let me know. Okay, so this is what a put ratio back spread looks like. Again, you have to maintain this ratio though. So a ratio back spread again, 1:2. Always maintain this ratio. You can go for 10, but then this will be 5. And you just have to make sure that this is the chart that you'll get. When you implement this, again, you're extremely bearish on the current markets. The markets have reached 17300. You've looked at OI, you've looked at everything. You expect the markets to significantly fall. Price action is supporting your view. There are increasing lockdowns coming into play, but you don't really want to just buy puts because again, they can just, if you're wrong, you will be really screwed. So in this case, it's much better to implement a strat like this. Again, it just costs you around 20K or something of that sort, and your max profit is unlimited. And even if the market goes completely against you, if there's a major movement in either direction, you will either make a lot of money or lose almost nothing. This is the advantage, right? You just don't want the market to stay here, hopefully move in your direction, but even if it doesn't, you are still good. You can play around with all these strikes and then you will get slightly different numbers. But in strats like this, where your probability of profit is already so extreme, it's really hard to find like better ones. Okay. Chalo, next. Oh yeah, there are ladders as well. Since we're covering everything, let's just look at it. I mean, ratio spreads and ladder spreads, these are extremely rarely implemented. I don't really know when exactly someone would. Okay, so let's just look at a bear call ladder. We won't look at the bull puts. So a bear call ladder is another credit strategy, and it's an improvisation of the call ratio. Now, this is something that you'll keep coming across now. Once you know the four basic strats, what a bull call is, what a bear call is, and the same for the puts, everything else is just a modification of the same. So what exactly is a call ratio spread? You're just modifying uh, a call ratio spread is just a modification of the previous strats that you'd learned, right? And now in this case, you're modifying the call ratio spreads, and now you're coming at a call pair call ladder spread. In this case, you can buy at the money calls, buy something at the money, 30th December. One, oh, ये क्या हो गया? Yeah. This is what a pair call looks like. And again, it's the exact thing. You're just modifying the strike slightly, using 3 strikes this time. You're selling in the money, out the money calls. And remains the same thing. Hopefully, you can calculate the max loss by yourself. And your max loss and everything can be calculated right here. So the spread minus the net credit, right? This will basically you use the in a way at what your max loss is. And why do you have break to keep it more money? And that is we're going to get just the same. If you have difficulties, then you can let me know later on. But I don't think it's important, especially since once you guys start playing around with Sensible or the free site Obstra, which is available, it's all the same. You will be able to figure this out, no problem. Just make sure you understand the first four and whatever option strat you have, that'll be okay. ठीक है, straddle करते हैं. Straddle. Okay, so this is slightly different. So straddles are basically delta neutral in a way where directionally it doesn't really matter where the market moves. This is probably the most simple to implement by this. Khatam. So you're basically buying at the money strikes. Ek call ka, ek put ka. And you can just look at it in isolation. Yeah, so if the market goes up beyond this point, you make some money. And if the market falls, you will lose quite a bit. You are just adding on another leg. And you now come up with this combined diagram. This is what a long straddle is, one of the most commonly used strats for option traders, long straddle, short straddles, and everything. Basically buying one at the money call, you're basically buying one at the money put. Where's the max loss? Exactly at the strike at which you've bought both of these. And your break evens are also pretty easy to calculate. Whatever your net premium is, so 170 and 155, okay, 15 points. So whatever net premium is, you can just add that to your strikes and you will basically get what your break evens are as well. Okay. So this is, I mean, fairly straightforward. When do you usually want to implement this? When the IV is low. Again, go back to the first instance, credit and debit spreads. This can be classified as a debit spread, right? Because you are paying money and you're basically long on options, right? Since you're basically long, you want the IV to be low and you want the IV to go up and you need a big move, but in either direction. No matter where the market moves, you will make a lot of money, but you just need the movements to be big enough. Because if it moves in one direction, it has to cover up the loss of the other leg that you have. So this is the main difference. Your probability of profit, again, 45%. The margins need are fairly low since you do have a limited loss. And yeah, and as I'm sure you guys have understood, this is not something that I usually implement. I usually focus on short straddles. Okay. I hope everything is clear here. This is just the first strat that you get, which is delta neutral. It doesn't really matter which direction the markets break in. You make an equal amount of money either ways. Even though in real life it isn't exactly equal, but for now, that's good enough. Okay. Now, short straddles. Short straddles are very nice. This is something that I do like, that I do employ. Again, all remains the same. Sell at the money call, sell at the money puts. You're basically done. As long as the market remains in this range, you will make money. So 16875 and 525. So the gap that you have for Nifty, right? This is a pretty good range. So 700 points ke aaspaas roughly. As long as Nifty stays in this range, I will make money. It's only when they move off completely in one direction is when I start losing. Okay. And I think over here you can probably see minus 1.97 and 1.81 in positive, right? Why are the numbers not the same? This is again because of the skew, right? There will be a difference between the prices of calls and puts depending on how the markets move. So I think short straddle is something which are really nice, especially around expiry. 30th. Something of this sort. I think this is really nice. You get like a 300 point spread right here. And as long as Nifty tomorrow remains within this 300 point range, which is pretty likely, right? Just from a mathematical point of view. From a mathematical point of view, this is extremely likely. And if this was a normal day, a normal expiry in the market, just generally ranging, I would probably pick this up and make a certain amount of money. If it falls completely in one direction, then you have multiple ways of adjusting all of this, right? You can either close this position and then go bullish using the spread strategies that you previously learned, or you can just buy a hedge. Buying a hedge means this leg, which is completely in a loss, you can just buy some strike here, and then everything will change. Okay, so if the markets fall off a lot, your max loss in this range will not be unlimited. So this is what the short straddle is. Again, you're just selling at the money strikes, your max profit, your net premium. This is fairly basic. And what you want the Greeks to do, your IV, you want the IV to be extremely high when you implement this strat, and you want it to cool off. You want it to cool off. You want the IVs to fall because again, you are short options. So since you're short options, you want the volatility to go down because that will help you out, and you want data to be on your side. Okay. Short straddle, and let's just the last one that we'll.
Yeah.
Okay, we have to
I
look
had
at.
a small doubt if you're okay with it. I had a small doubt.
पूछो पूछो.
Acha, so like we can also calculate the market movement with the straddle pricing, right? How the straddle is pricing in it at the very day.
You can,
Like they
but that's a
could
very roundabout
you
way. Basically, you can look at 100 strikes away. At the money is 17200. The market's exactly at 17200. What exactly is the price of a 17300? What exactly is the price of 17100? And then you can have it like a general idea as well, based on the difference
okay? So
between the
like
prices that you can see.
and then also we can implement this strategy like the straddle short straddle.
But again, I use price action for all of my trades. This is when I will implement any of them based on price action, what I expect the price to be, and where I expect them to fall. It's just that I look at all these strategies to implement based on whatever has been done. So as of right now, I would definitely go for bear call spread, right? Because the markets have gone up from 16800, call premiums are extremely high, and I want them to cool down. So since my view has been established based on price action, the strat that I'm taking is based on whatever strat fits my bill best. Okay, I mainly look at credit spreads only because I want theta to be on my side. And then since I have the call premiums really going up, this seems best. Makes sense. You need to have a
Makes
view, be it
yeah, sure.
technical or price action or whatever it is.
Okay. No, thanks.
As long as you understand the first four, I mean, everything else is extremely simple. After a certain point, you don't really need this chart as well. You can just have a general idea and figure it out, you know? Okay, let's just look at straddles and then we'll move on to condors and then for finishing this lesson. Okay, why should you? This is all the same. Okay, so this is your strangle. And again, since you make profits, you can see you make profits in either direction. The only difference here is you have a wider break even. So now the problem here is why am I looking at an even brighter break even? I anyways expected the markets to have a big move. So why this? The advantage here is the margin required. It does fall quite a bit. So the margin does fall, and you do get basically the same benefits since your view remains the same. You are extremely bullish or extremely bearish. You just want the markets to move from here. So even if since you have such an extreme strat in play, an extreme worldview in play, why not just implement a strangle instead? Okay, so it gives you a greater buffer. I mean, a worse buffer, but you do get certain benefits with it, right? So this is again one of your lower a lower cost strategy since this is slightly cheaper. Instead of at the money strikes, you're basically buying and selling out the monies. So you're buying out the money calls and you're buying out the money puts. Okay. Now this is even better. Short strangles. Over here, if you remember your strike prices from the previous example, they're even better in this particular instance. This is again because of the fact that instead of going for at the money strikes, you've actually bought out the monies, right? One strike away, you can go for two strikes away, three strikes away, it doesn't really matter. And it just gets better in a way. your probability of profit will just keep going up, and you have a extremely wide range where you can still make a certain amount of money. So straggle, just like we looked at ratio spreads and we looked at ladders, which are basically improvisations. This is again a strangle is an implementation or an improvisation of a straddle. So a straddle is extremely linear. This one gives you slightly more leeway. So again, you expect the markets tomorrow to fall to remain within a certain range. This is something which you could look at. You have such a wide range here. Even in the last example, you had 300 points. Here you have even more, right? So 170.30 all the way to 370. As long as the market remains within this range, you will make some money. Now, some people will scream and shout about the max profit being so low, but because of the probability of profit that you have, it's extremely beneficial. Okay. Okay, let's. The last thing, again, I hope the max loss, the break evens, those are fairly clear to you guys by this point. Your max loss again will just be the premium received, right? In case of the short strike or short strangle, you're just selling one out the money call and you're selling one out the money puts. That's all it is. Okay, so iron condors are just a modification. They are a short strangle modification. So we're just building on one over the other. In iron condors, you basically have four legs. This is the first one. So you're basically buying the same. Okay, so I hope here this is extremely simple. This is just a regular strangle, and then you can modify this by adding two more legs. Okay, and this is basically an iron condor, and that's it. Four legs. You have just basically combined all the strats you studied so far. For example, the first thing that we looked at, right? The first spread that we looked at, the bear call spreads. What are you basically doing? Selling and then buying something which is even further away. Here, you can basically look at these as two. Once you're selling something 17050, and then you're buying something which is even further away, and here you have the exact same thing here, right? So 350 and 250. In this case, you get a pretty nice range where everything is limited. Now, the main reason why people opt for for iron condors is again, since your max loss is limited here, your margin required is extremely low. So in 40K, you can implement this strat. Obviously, with just 1 week left, you won't really make a lot of money. You can play around the strikes. Here, the probability of profit is extremely high, 17069 or 331. As long as the markets move above here, you are guaranteed to make money. It's just the probability of profit that you're playing in this particular instance. You can play around the strikes, then you can find multiple things. So with all of these, with any iron condor, even in the inverse, right? You just have to play around with the four basic strats, just understand them properly, make sure you can plot them out and chart them out, and you should be able to construct anything in the world. There are other strats as well, and even the ones we've discussed today, like strangles, straddles, and iron condors, this will be discussed in even more detail by the Vailama and others. So just a rough introduction to the four basic strats, using calls to short the market, using puts to long the market, using calls to go long, using puts to go short, a couple of modifications, and an introduction to straddles, strangles, and iron condors. The exact ways that you can modify them or set stop losses will be taught to you later on. But I hope this is clear. Any questions here? Any doubts?
The one you've made right now is a long iron condom, right?
हाँ लॉन्ग का मतलब बस यही है कि यहाँ पर ग्रीन होएगा ना
हाँ, like
इसमें
the like 1 SD or 2 SD move के बाद only you'll make money instead of
हाँ
it being in between those two. Yeah,
to be
sure.
very honest, I don't really remember the names anymore. मेरे को exactly नहीं पता, but this should be a long iron condor.
I think this is a long iron condom
हाँ
because
long ही है,
you're
but I'm just saying
if you just
नाम वाम का तो
हाँ, ठीक है, that's okay.
Okay, so the other things will be discussed in the future as well. Just a couple of things. I hope you guys understand what covered calls are and what wheels are, right? And exactly how I hope that you guys use all of this. I want you guys to play around weeklies or monthlies. Choose directional strats. Choose strats where you have a fixed stop loss, where you have a fixed, maximum loss, and just play around with them. Don't really focus too much on, okay, I'm making 950 bucks, but I'm losing 4,000. I need 40K to make 1K. It doesn't really matter. As long as you're making any amount of money, even if you're spending 40K and making, 50 bucks after brokerage and taxes and everything, it's still fine. Just gather the experience, the money will come over time. Just understand what the markets work, how the markets work, just stay in the markets and you will make money eventually. Okay, so ignore all of these numbers, just focus on the probability of profit, see how much money you can make, and you can implement strats like a bull put spread or something of that sort. You can close them off early and then implement new ones. Okay. It's not like you can just make 2K a day. And for all beginners, I explained this last time as well. Just start off trading with one lot. It doesn't matter how much money you have, whether you have 1 CR or 10 CR, just start off with one lot. Once you become profitable and once you've doubled your money or at least made like 50% or something of that sort, that's when you can implement all of your money at once. But until then, just stick to one lot. Okay. Now, covered calls. Unfortunately, you can't really show covered calls here on Sensible, but hopefully this is extremely easy for you guys to understand. What you're basically doing is, okay, there's no need for the screen anymore, so I'll stop sharing. Yeah, so in a covered call, it can be covered in two ways. It can be covered using cash. I think some guy on ISB, the subreddit today, he'd made like 35 lakhs from 1 CR of capital. I don't know if it's true or no, but yeah, he was playing covered calls and he had cash covered calls. So in cash covered, what you basically have is you are ready to pay up the money. Okay. But the usual way how most people implement this is, suppose you have one lot of a certain stock. Suppose you have ITC. You have ITC at 200 bucks. And now ITC has gone all the way to 240. You know ITC will go back down to 200 because the fundamental support you view, the technical support you view, and then it's ITC at the end of the day. It's a stable coin. So it will go back down to 200. So you can sell 260 calls. Okay. Now, what happens? Suppose the market goes above 260, which is highly unlikely, but even if it does, okay, your option will lose some money, but your portfolio will go up in value, right? Because the entire market is moving upwards, and if IDC is moving upwards, everything else should move upwards as well. You can look at strats not just in isolation, but with your entire portfolio as well, because you do have a lot of money in the markets. So if you want to isolate everything and think about it from a theoretical point of view, that is fine as well. You can just look at if ITC breaches past 260, which is a major support that I had identified earlier on in my analysis. As long as it breaks 260, I think my portfolio, my ITC stock going up in value will be really good. And until that doesn't happen, you will just consistently keep making money for no reason. So ITC is at 240, sell 260. ITC is at 220 now, sell 240, and keep making money. Whenever your option loses value, it's fine. Your stock went up in value. These are kind of win-win trades that people should implement, especially beginners. If you have enough capital to do something of this sort, I would highly recommend it. The risks are fairly low, especially for a large enough portfolio. You can just buy like one lot of a certain FNO stock, and then just keep running calls here, and then just keep running covered calls. Now, let me just explain what cash covered means. What cash covered means is you are ready to buy the stock in case that happens. Okay, let's just take the same ITC example. You have fundamentally analyzed the company and you think it's absolutely brilliant. You uh, you have no problems with the company at all, and you looked at the admin score and everything. It's a fantastic company. You think it'll really go up in value, and you are fine in buying ITC even at 300 bucks. Okay, so what you can do in this case is you can again take up the same strategy, take 260 calls and sell them. Now, if the market stays at 240 and falls back to 200, okay, fine, great, you made some money. Now, what really happens if the market goes past 260? If the market goes past 260, you will be assigned. You will have to buy that shares. But since you are cash covered, since you have enough cash in your bank account, you can just pay up that money and then take up one lot of IDC shares. and then you can continue the entire process. Now you have ITC at 260. What do you do now? Sell 280. And then you have the shares, right? That's the exact same thing. Now you have ITC at 260, you can sell 280. If the market falls or if it doesn't cross 280, great, you made money. Because the option, you've sold an option, it didn't breach that limit, you've made money. Now if it does go past 280, great, ITC went up in value. Again, a win-win trade for you. So this is how you can start converting your covered calls into proper wheels. And this is how exactly how a wheel works. So the only problem with wheels is you have to be extremely sure of the stock, and you should be willing to back hold it. There are very limited stocks you can run wheels on, especially in the Indian markets. So stocks that you think are fundamentally extremely strong, nothing will happen to them. Stocks like Reliance or maybe HDFC Bank or some of these stalwarts that everybody knows and hears about. As long as you fundamentally analyze the company and stuff, you can just implement these wheels. It's a fairly simple way to make some passive income. So wheels and covered calls, probably the best ways for regular people to make passive money. If you're a beginner and you can't really monitor the chart all the while, what you can do is just take one lot, sell these bull call, bull put spreads and everything, keep theta with you, and keep your spreads low. In these examples, I purposely looked at 150 spreads, right? Because 150, it does mean that you won't lose more than like 4K, 5K in a week, even if the worst happens. And even then, you can have a stop loss. So even if in a week you're completely wrong all 4 times, the max loses 8K. And hopefully you would have learned something over that time period. So yeah, I guess this was my class. Hopefully this has been slightly more clear and understandable. If you have any questions, you can let me know.
I don't have any questions, but like, others might in the chat.
I actually am getting a call right now as well. So I'll just cut this class right here. If you guys have doubts, just let me know. Just type them out and then I'll come and answer them. Okay? Chalo.
Thanks for the
Thank you.
class, man.
Thank you for your time, guys. Bye. Good night.
Thank you.